Something strange is happening in the mutual fund industry since the beginning of this year. More and more fund houses are holding on to cash instead of doing what they're supposed to, invest in the stock markets. But here's what's really interesting. Although they're holding on to massive cash piles, they're still raising more cash from investors. Between June and August this year, mutual fund houses have launched 32 new schemes and have raised over 30,000 crore rupees despite sitting on 2 lakh crores worth in cash. But why? Well, this is strange because in the time period these fund houses have increased their cash reserves, the Indian equity markets have created countless all-time highs. But why would they sit on cash when the market is creating wealth for its investors? Plus, if they're struggling to deploy the cash they already have, why are they raising more funds? Something just doesn't add up. If you're as curious as we are, you're in the right place. In this episode of InShorts TV, we'll break down exactly what's happening here. So make sure to like this video and subscribe to our channel. Let's take it from the top. Before we dive in, let's start by understanding how mutual funds operate. Think of mutual funds as a middleman. They collect money from thousands of investors, pool it together, and invest in stocks, bonds, or other financial instruments. So, how do they make money? They charge a fee, primarily in the form of expense ratios. Every mutual fund has a fee structure which includes management fee, administrative costs, and distributor commissions. These fees are usually a percentage of the total assets under management or AUM. For example, a fund might charge 1 to 2% of their AUM. The bigger the AUM, the higher the fees these funds collect. That's why the fund houses are always incentivized to grow their AUM. More assets under management means more earnings for the fund managers. And by doing this, by collecting the investors' money, they want to create wealth for them. They do this by investing in the stock markets, like I've already told you. Investors hand over their hard-earned money because they expect that mutual funds will buy stocks, generate returns, and grow their wealth. But majority mutual fund houses in India are not investing a significant chunk of the money they've raised. Let me actually give you some numbers to put this into perspective. ICICI Prudential Mutual Fund is sitting on close to 32,000 crores of cash. SBI Mutual Fund is sitting on over 27,000 crores of cash. HDFC Mutual Fund is sitting on close to 24,000 crores of cash. Parag Parikh Financial Advisory Services or PPFAS is sitting on close to 16,000 crores of cash. This is around 18% of their total assets under management. Quant Mutual Funds is sitting on close to 13,000 crores of cash, which is around 14% of their assets under management. Other funds are also sitting on huge cash reserves. You can see a detailed list on your screen. After seeing this, you might be thinking, if the main job of a fund is to invest, holding large amounts of cash is counterintuitive, right? Cash, after all, does not generate any returns. When a fund holds too much cash, it means a part of the investor's money is not working for itself. So why would these fund houses, whose survival depends on generating returns, choose to sit on the sidelines? Well, the answer has to do with the current market valuations. Remember, I told you in the beginning how India's stock market has reached multiple all-time highs since the beginning of this year. This has made many people start feeling that maybe the Indian markets have now become expensive. Even numbers say this. The price to earning ratio of Nifty 50 is at around 23.2. This simply means investors are paying 23.2 rupees today for every 1 rupee of future earnings expected in FY25. For context, the historical PE ratio is around 16 to 17. A higher PE ratio like this suggests that market might be expensive and overvalued. On top of that, the market cap to GDP ratio is now at 132%, which is way above the long-term average of 85 to 90. This ratio is also known as the Buffett indicator. You know, after Warren Buffett himself. And when the number is over 100, it means the market is overvalued. All these signs point toward the market being expensive at the moment. And because of all of these factors, fund managers seem to believe that investing at these levels could be risky. They fear that any negative news, like an economic slowdown or poor corporate earnings, could trigger a market correction. This means the markets could fall. And in such a scenario, the funds that have hoarded cash will be in a much better position. They could buy more stocks at lower prices and would also have less losses. Fair enough. So fund managers don't see opportunities to invest in the markets at the moment. But if that is the case, then why are they calling more capital? Why are they raising more cash? Why are fund managers launching more funds? Shouldn't they wait for the markets to cool down before asking investors for more money? Between June and August 2024, mutual funds have launched 32 new funds and have also raised close to 32,000 crore rupees. This is despite the fact that they're already sitting on 2 lakh crores worth of cash. The thing is, why would they do this? Here's why they're doing this. You probably remember, like I told you some time ago, that a significant amount of a mutual fund's earnings is dependent on the assets under management. More AUM equals more fees. And one way to boost AUM is launching new fund offers, also known as NFOs. This way, they can steadily keep growing their fees month by month, even though they are being cautious with deploying the money. Fair enough. But is sitting on cash the best strategy to grow investors' money? Sure, if the market dips, sitting on cash would mean they will be able to buy stocks at cheap prices. But at the current pace, India's stock market is not showing any signs of slowing down. And if the market keeps climbing, these funds will underperform because they are holding cash instead of staying fully invested in the markets. For investors, it can feel like missing out on potential gains because others are riding the market rally and they couldn't. This is a risk Indian mutual funds are taking up because no one can predict how the stock market reacts in the future. Do you think this strategy will pay off? Let us know in the comments and subscribe to FinShots TV for more.